G'day everyone, welcome to this weekly update for Australian and global markets. And the fear that we saw over Greece and then over China a week or so after that has largely calmed down and people have pretty much forgotten about it. There's been some very important decisions in the Greek Parliament, but it's not even making the news at all these days. So they've all kind of faded into the background and been replaced by what's happening with commodities. And it was just a continuation of what we've seen for most of the last 12 months, with some very heavy falls in commodities. So let's have a look at the action for last week. And as I said, commodities have really taken over the fear that people seem to want to have about something or other. And strangely, with all the uncertainty around, the flight to safety that you'd normally see to gold has not occurred. In fact, gold has not only not held its ground, but it's been hit very heavily indeed. We've also seen iron ore down 35% in a year. We've seen oil down 52% over the same period of time. So aluminium is down. Pretty much all commodities are down, and that's a really bad sign for global economic growth. The other current news story, I guess, at the moment is US earnings, and they're generally okay relative to reduced expectations. So if you include all sectors, including energy, then the expectation was for earnings to fall about 4.5%. If you exclude energy, which are obviously, those companies are suffering very badly, but if you exclude that, then the market was looking for still fairly mild earnings growth. That's by and large been achieved. There's been a few misses. There's been a few, or quite a few beats. There's still something around 70% of companies reporting are beating expectations. So it's not too bad, but it's nothing to really get excited about because growth in earnings is definitely slowing. There's no question about that. So if we look at American stocks, the S&P 500 index was down 47 points on the week. And as we'll see from the chart, there is a definite slowing of the main trend. Now, whether this is just a pause and then the uptrend will resume, we'll have to wait and see. But certainly there is a definite slowing going on now. But it's still a very mixed situation with regard to value. There are some stocks, Facebook and Amazon and stocks like that, Tesla, Netflix, that are trading at absolutely insane valuations. Yet there are other stocks like Apple that are trading at very attractive valuations still, despite the price rises. So it's still a very mixed situation. And the other thing that is of note too is that there's been some very big price fluctuations in individual stocks, and we saw some sharp falls, 4 or 5% in some of the best stocks on the US market for absolutely no reason on Friday night. Yet we've seen very little lift in the VIX index or in fact in the trading volumes. So there doesn't look to be any real commitment to the selling. And that's a strange situation. I can't recall having seen such big price fluctuations in large high quality value stocks without the VIX index getting up above 20. So it's far from normal. Now looking at the Australian market, the Aussie dollar remains in a very strong downtrend and actually really confirmed the break of support around 75. We're trading down around 72.7, and you'd be a brave person to say that it's not going to drop into the 60s at this stage the way that it's looking. The ASX 200 index ended up down 104 points for the week, and it's a really interesting chart pattern that we'll take a look at. Is this just a false break of a trend channel, or is something different going on in the Australian market? So let's take a look at some charts. We'll start first of all with the S&P 500 monthly index. Now you can see that we've not got the blue line here is the 12-month moving average, so the 12-period moving average on a monthly chart. So you can see that we're still holding above that moving average line. So there's been no significant change in trend, but you will notice that it is slowing. We are starting to get a bit of a rounding top formation. The index has been overbought on a monthly chart, as you can see, since around about February 2013, so about 2.5 years. Now, that doesn't mean that there needs to be any drastic change. I know there are still plenty of people out there that want to call an end to this bull market from 2009, but we're not there yet. But I think a little bit of caution is warranted. If you now switch to the daily chart, you can see that there's definitely been a lot more ups and downs, a lot more volatility within this last period. First disturbance we had was October last year. It's moved up higher, but you can see that it's definitely lost upward momentum. And Thursday and Friday were fairly sharp days down. Now, I know there were a few less than ideal earnings reports, but some strange moves. And if we look at, as I mentioned, the VIX index, you can see that despite those fairly sharpish moves on Thursday and Friday, the VIX index hardly moved. It went from below or just on 12 and finished just on 14. That's not really very much at all, when the long-term average is about 15. So the volatility index is still below its long-term average, and that kind of doesn't marry up with the price fluctuations that we've seen. So very interesting situation at the moment. If we look at the Australian ASX 200 index, you can see that we've definitely had this downward trend channel in play now since around about April of this year. We had a break north of it about a week and a bit ago, and then we've retraced back to the top of that trend channel. Now, given what happened in America on Friday night, our market is almost certainly going to go lower, and particularly with commodities as well. So I would expect that this index will be, Monday's candle will be well and truly back inside this trend channel. So not sure what's going on. It could be we're in a period here of more consolidation. So it might just go sideways in this box for a while, or it may just drop back into this trend channel and continue its downtrend and form new medium-term lows. We'll have to wait and see. Not sure which way it's going, but certainly I don't like the look of the Australian economy, and it's extremely hard still, despite the decline in the last 3 or 4 months. It's still hard to find value in Australia. So, it pains me to say it, but I don't particularly like the Australian market at the moment. You've got to be extremely careful if you're playing in that space. And just taking a quick look at the Australian dollar index. So you can see we've been in quite a lengthy downtrend. We peaked out in July of 2011 at about $1.10 to the US dollar. It's been all downhill. We had then a very lengthy period of consolidation through to about May last year, so about 15 months. We were still trading at parity in May of 2013. And then since then, we've dropped from parity with the US dollar, and we're now down to levels that we've not seen in a very long time. And you can see that the next two major support areas, we've got a support area that we're just coming up on right now, about 72.5. So that's an important support area. And with the Australian dollar oversold, we may get a little bit of a bounce. But if 72.5 breaks, then really we're looking down in the low 60s. Now, it might take well into 2016 for that to play out, but that's the sort of potential move that we're looking at. And all you can say at the moment is that there's a very, very steep downtrend in place. You can tell by the angle of the red moving average and the fact that the price is well below that moving average. So all signs that this downtrend in the Australian dollar has got some real strength. So interesting to see what happens in coming weeks. So turning to commodities, gold was lower by $34 on the week, but it did reverse off a long-term trend line, which is really quite interesting, and we'll take a look at that in a minute. When it comes to gold stock indices, we may get a bounce from oversold because it is quite dramatically oversold, but longer term it's still a long way down to the next meaningful support. And again, you'd have to be a brave person to say that it's not going to happen. So we'll look at that gold chart in just a minute. Copper was lower by lower to $2.38. So again, just confirmation of what is becoming glaringly obvious, and that's that global economic growth really is pretty weak. Crude oil slipped back again. It was trading up at 65 not that long ago. It's down now to 48 and looking pretty bearish. Let's just take a look at those gold charts. So we'll start first of all with the daily gold chart. So you can see a bit of a rebound on Friday, finally, from oversold, but I wouldn't expect too much. Let's look at the weekly. Now, if we pan back, you can see there's a long-term trend line that really goes back to June 2006 on a weekly chart. So we're picking up lows in 2006, 2008, and now for the first time since 2008, we've come back and hit that trend line. So we got a bit of a bounce off that trend line. As you can see, it was almost exactly off that trend line. But look, lower levels are entirely possible, and I wouldn't be surprised to see it have a go at around the 1,000 mark. Now, if we just look at one of the gold stock indices, you look at the HUI index as an example, you can see it's been very, very steep decline. In fact, far steeper than the price of gold. And of course, the gold stocks do tend to lead the price of gold in both directions. So you can see that was a major support level that broke around 150. We're now down to 110. And really, whilst as I said, we might get a bit of a short-term bounce from oversold, you've really got to come all the way down here to about 40 for the next major support. So gold stocks potentially, I'm not saying it'll happen, but potentially could lose another 2/3 of their value. So it's a very, very ugly situation in gold at the moment. There's the spot copper chart, so you can see from up around just under $3 mark, it's been a fairly meteoric fall in really just about 3 months. So overall, no change to the slide I put up last week. You've just got to expect ongoing volatility. We're certainly seeing more of it now. July tends to be a reasonable month, but we're almost to the end of July. August and early September can be fairly nasty months. So we might see some upheaval in August. So for me, the only prudent approach is you just must own high quality assets. If you've got any rubbishy stocks in your portfolio, for goodness sake, get rid of them. And if you're buying high quality assets, then you need to be buying them below fair value. It's not just enough to buy good quality assets, because they could still go down in a general market correction. And the other thing is, just don't be reliant totally on capital growth. Have some other strings to your bow, and members know, of course, what I'm talking about with respect to those other processes that can underpin your returns very nicely. So for anyone that who's not a member, who would like to find out more about what we do and how I may be able to assist, there's my contact details. That's all for this week.